Welcome back to Investing So Every Day is Saturday. So, if investing has ever felt confusing for you or intimidating, this video is for you. So, your path to financial wealth, it was going to start with just a single step. So, today, I'm going to break down the essentials of investing into clear, actionable knowledge so you can build wealth with confidence. Let's get into it here. First, quick disclaimer. So, before we dive into this video and this channel, they're basically just for educational and entertainment purposes only. Nothing here is personalized financial investment, tax, or legal advice, and I'm not a licensed financial advisor. So always do your own research and talk to a qualified professional before making investment decisions. All investing carries risk, including the potential loss of principal. Past performance, including any numbers that I show today, doesn't guarantee future results, and any brokers, apps, or books I mention are for reference only, not paid endorsements. All right, so now that we got that out of the way, let's go ahead and get started. But actually, one more quick note here. So this video is going to be talking about kind of just investing for beginners. And my other videos on the 3-engine portfolio and the options challenge are a little over a week late. But I have updates coming soon, either tonight or tomorrow on the 3-engine, and either tomorrow or the next day on the options challenge. And kind of just a sneak peek at the options challenge. It's that one's looking pretty ugly, but more to come on that one. So let's start with the single most important thing here. So it's for the single most important concept here in investing, actually, it's compounding. So compound interest means that your investment earns returns on both your original money and the returns that it's already generated. So over time, that creates exponential growth. It's not a straight line. It's a curve that gets steeper the longer you wait. And so the earlier you can start, the better off you're going to be. So here's a number that should get your attention. So if you're just investing $100 a month at a 7% average return, that's going to grow to over $120,000 after 30 years. So that's the magic of starting early. So imagine if you just took that $100 a month, that'd be $1,200 a year times 30. It's about $36,000. If you were to put that in a bank, you'd probably get, even if you got $10,000 in interest over that 30 years, you'd have about $46,000. But if you invested it, you see that 7% average return. And again, these are just hypothetical numbers. That could be $120,000 versus $46,000. So the sooner you begin, the harder your money works for you. All right, so setting your financial goals. So before you invest even a single dollar, ask yourself, why am I investing? So knowing your why shapes how you actually should invest. So goals generally fall into two buckets. Short-term goals, which are under 3 years. Think about emergency funds, a vacation, or saving for a down payment for a car. For these, stick to low-risk options like savings accounts, CDs, high-yield savings accounts, or money market funds. You don't want market volatility touching this money that you're going to need soon. And then long-term goals, 5+ years, retirement, financial independence, long-term wealth building. Here, you can embrace growth assets like stocks and ETFs because this smooths out the ups and downs over time. And then understanding your risk tolerance. So this is kind of your ability and willingness to handle markets ups and downs without panic selling. So I've been through this a lot. I've panic sold a lot. I'll buy something as it's going up, and then it'll shoot down, and then I'll sell it, and I just lose the money. But a lot of this is shaped by your age and your goals, and then honestly, just your personality. Now, if you're conservative, this one's going to prioritize safety, and this prefers bonds and cash, low tolerance for loss. And if you're moderate, see here, balances right here. What does that say? Balances growth and safety. So it's kind of a mix of stocks and bonds. Maybe 80% stocks, 20% bonds. And then aggressive maximizes growth. So if you're comfortable with the volatility, this usually has a longer time horizon. So if you're young, you can usually do this. So you got more time for it to go up and down. If you're getting ready closer to retirement, you don't want to be too aggressive. But you got to be honest with yourself. The best strategy is the one you can actually stick with when that market drops, because it's going to drop. Some investment vehicles here that you need to know. These are some of your options. So what can you actually invest in? And so these are some of the main options here. So with the stock, that's most of you are familiar with that. It's so that you'll own a piece of a company. It's got high growth potential but higher volatility. And these are definitely best for long-term goals. Bonds, you're lending money to governments or companies. It's got lower risk, steady income, and it's ideal for more conservative investors. And then mutual funds, these are professionally managed baskets of assets. They have instant diversification but offer higher fees. And then ETFs, to me, those are kind of similar to mutual funds, but they trade faster. They trade like stocks, but they hold diversified assets. So they hold more assets within those ETFs. And they have low fees, they're flexible, and they're genuinely beginner friendly. So like, just as an example, VOO or SPY or QQQ would be examples of ETFs. So if you're just starting out, ETFs are usually the easiest entry point. So you don't have to think too much about trying to find stocks. And you really shouldn't have too many single stocks in your portfolio. I mean, it's up to you if you love certain stocks, and you might want to do that. But diversification is going to be your best defense. So I'm sure you've heard this phrase, don't put all your eggs in one basket. That's really diversification. So spreading your investments across different assets, types, industries, and regions, so like banking or tech or consumer staples, that would be diversification. So diversify across all those different asset classes, as well as stocks, bonds, real estate. So they have REITs. A good example of an example of a REIT would be ticker symbol O, Realty Income. That one pays a dividend. And then you have like a stock like Microsoft, MSFT. That's just a single stock. Bond. You'll see this in the 3-engine portfolio, like USHY. And then there's different sectors. You have tech, healthcare, consumer goods. So think about like home improvement or home building. You would think Home Depot or Lowe's. Groceries, you might think of Albertsons, or think of Coca-Cola or Pepsi. So, and then geographically, you can also invest more internationally. In my 3-engine portfolio, I use VXUS, which is an international ETF. So the easiest way to get all of this into one move is definitely by index funds and ETFs. This will give you instant diversification into in one single purchase. So getting started is the important part here. So you want to get started. A lot of people just will sit on the sideline, or they'll just wait either until they make more money, or they reach a certain age. There's so many excuses to do it, but you just got to get started. So basically what you want to do when you get started, you want to open a brokerage account. And then once you do that, you can choose your platform. There's brokers like Fidelity, Vanguard, Charles Schwab, Robinhood. There's so many out there. You can do a quick Google search or an AI search and find different ones and even compare them. And then just look for the ones that have $0 commissions and low fees. And then the next step would be to open your account. And then you'll need your ID, your social security number, bank info. And most of this just takes about 10 minutes online. Then the next step would be to fund it. So you'll want to link your bank account and transfer in some funds, and maybe even try to set up an auto deposit, so that you're putting the money in automatically, either monthly or weekly or every 2 months. So a lot of the platforms too, Robinhood, Schwab, I'm not sure about, I think Schwab does it. Vanguard might do it, but you can invest with just as little as $1. And then the next step would be to make your first investment. So a low cost index fund or ETF is going to give you that instant diversification. So maybe a VOO into the S&P 500. Again, not investment advice. I'm not telling you which one to choose. Do your own research. But definitely you'll want to get started. This kind of covers some common investing mistakes, and these are things you're going to want to avoid. A lot of these are things that beginners will make. I've made these mistakes. So just waiting too long, and then so time is your greatest asset. So if you wait till you're 60 years old and you invest till 65, obviously you're not going to do as well as if you started when you were 30. Because time is definitely your greatest asset. So delaying even 5 years can cost tens of thousands in compounding. So waiting to get started, you should definitely try to do it as soon as possible if you can. I mean, everybody's situation is different, so definitely try to get started. Chasing hot stocks usually is a mistake. I've tried this in the past. I've heard of some names as they're shooting up, and then I buy into it, and next thing you know, it just drops. So this is the momentum investing based on hype, and people just hyping up the stocks, and you'll get a lot of YouTubers or a lot of people just saying, buy GameStop, just buy it now, and end up buying it, selling it high, and then you'll end up panic selling. So like, even if you bought a good stock, if you buy, say, or an ETF, let's say you bought the S&P 500 and you see it start to drop, and then you'll panic sell. The market will dip, which is normal, and you'll just start selling as it's going down. And usually you just kind of wait. You got to have the stomach to wait, but again, that's when you'll have to assess your tolerance. And you also, ignoring the fees, that's kind of a big thing. So if you look at the stocks when you're purchasing them, when you're buying them, you'll see the expense ratio or the expense, and you want to make sure that you want to have it 0.0 or 0.03. You'll see those different ones. So like 0.03 would be like $33 for every $1,000 invested. So it would add up over time. So the higher those fees are, if you have a 1% fee or a 2% fee, you're going to be paying a lot of money. So, and that money comes right off of your investment. So, and then definitely here's some resources that I like for some further learning. So if you want to get deeper into it, these are some books that I've read. It's The Simple Path to Wealth by J.L. Collins, The Little Book of Common Sense Investing by John Bogle, and I Will Teach You to Be Rich by Ramit Sethi. And then we also have some other online resources. Investopedia for some definitions. We have Bogleheads.org for community wisdom. NerdWallet for some broker comparisons. It'll tell you which ones might be best for you. Plenty of podcasts out there. Motley Fool, ChooseFi. Take your pick. There's several of them out there. So your investing journey should definitely start today. And again, I'm not telling you to invest necessarily. I mean, if you can do it, I would say if you're going to do it, start now. Start right away. They say the best time to plant a tree was 30 years ago. The next best time is today, right? So you want to get started. So here's the truth. You don't need to be an expert to start building wealth. You just need to start. So your plan of action, this week, I'd say, if you can, open a brokerage account and try to fund it with $50 to $100. Maybe even set up monthly automatic contributions. $10 a week, $25 a week, it all adds up fast. And if you're not doing any of it now, that's $10 more than you're doing now. And then so this year, try to build up your portfolio and just keep learning. So as you're investing, continue to do more reading and more research and learn and figure out what works best for you. But definitely just stay the course. Just get in there and invest. Some of the best investors are lifelong learners like Warren Buffett. You gotta keep asking questions, keep growing, and remember the 3-engine challenge and the options challenge update are gonna come very soon. So if you subscribe and turn on notifications so you don't miss them. And if this has helped at all, please drop a like and subscribe for more. And let me know in the comments what's going to be your first step. And I'll see you in the next one.